The whole market structure and all the participants in the markets have evolved very rapidly over the last decade or so. If you look at NYSE Euronext on a global basis, we operate 7 equities exchanges and 8 derivatives exchanges. In the US, there are 11 equities markets, and we operate 3 of them. In addition, in the US, there are about 30 to 40 alternative trading systems, also called dark pools, and over 200 broker-dealers that also trade orders. The reason that they're called dark pools is because they generally don't display quotes, but they do execute orders. They'll use the quote of the public market as the price to execute their orders, but they don't actually display quotes in the marketplace or participate in price discovery, which is why the term dark pool has become prevalent. Reg NMS was one of the more comprehensive and complicated rules that was passed in the U.S. equities market in the last decade or so. The most significant impact of Regulation NMS is that it essentially forced the markets to go fully electronic. It prioritized electronic quotes over non-electronic quotes, and it prioritized the best quote at each venue over any other liquidity in the marketplace. And so a lot of the technological improvements and the speed and the efficiencies that we've seen come into the market have come from a lot of the Reg NMS construct. Because there's been such an influx of speed in the markets, and because routing happens so quickly, we're literally measuring transactions in millionths of a second. There's a lot of different paths that orders can take before they make their way to their ultimate destination. Sometimes people are looking for speed, sometimes they're looking for anonymity, sometimes they're looking for lowest cost. There are disclosures that different brokers need to make about where their orders are going and how they're being routed. So investors who are curious about where their orders are generally going can look and find out. Orders and investors have a lot of different options in terms of where orders go. Orders can go to an exchange directly, but in a lot of cases they'll go to either brokers first or dark pools first, and will then eventually get routed to the exchange markets. And one of the concerns that has been raised is whether the level of orders that don't participate in the public markets will get to a point, or is at a point in certain circumstances, where it is impacting price discovery and the display of orders in the public markets. One of the things that we've recently done is filed for the ability to provide price improvement to retail orders on an exchange. It's something that's very commonly done in the private markets, but it's something that an exchange historically has not been able to do. It's all part of the evolving cycle as competition evolves and exchanges look to become more competitive with different types of venues in the marketplace. May 6, 2010 was an instance where we had a day with a lot of global macro uncertainty, a very skittish market without a lot of liquidity. Almost instantaneously, we saw the market essentially fall almost 10% and then recover within minutes. We on NYSE always had circuit breaker-like mechanisms that enabled dampening of highly volatile situations, but mechanisms like that didn't exist on a market-wide basis. And so what you've seen is a lot of action out of the regulators to institute cross-market protections to prevent another May 6th type event from happening. So we've got single stock circuit breakers that are being transformed into something called a limit up down plan. We've seen short sell restrictions be put in place. We've seen stub quotes be eliminated. We've seen market access rules be implemented. It's really focused around a notion that in a fully electronic world like we live in, there are times where perhaps it makes sense to slow the markets down, let them replenish themselves, and prevent what otherwise might be an overreaction in the marketplace from happening. A lot of what gets referred to as high-frequency trading really is automated market making and isn't something that we think, just based on its face, should be feared. Now, the important thing that every market needs to have is a strong surveillance function, and to the extent there is bad activity that's happening in the marketplace, it's important to ensure that the regulators have access to the right types of data so they can monitor the types of activity that are happening and make sure that any type of potential manipulative activity is caught and rectified. But at the same time, just because we have a lot more technology operating in our markets isn't necessarily a reason to be concerned. There's been a number of initiatives around charging the banks for their activity through financial transactions tax as a way of levying a cost onto the banks for some of the bailouts, and instituting such a tax on transactions is the wrong way to institute that type of a mechanism, because it will impact liquidity, people's willingness to make markets publicly, and a lot of those types of fees will be passed back to end investors. The important thing is for us as an industry to step back and look at how markets are developing and recognize whether there are additional safeguards that we should build into the system, and to ensure that the regulators have the right tools at their disposal to monitor and understand the different types of activities that are happening.